Hello and welcome. You're watching All About Your Company here on ET Now, and I'm Harsh Saita. Today we're going to be speaking about Euro Pratik Sales. Why are we talking about them? Well, when the real estate cycle has picked up, you will likely see ancillary beneficiaries, and Euro Pratik Sales, which is the segment that it caters to, is a clear beneficiary of that cycle. We'll try and break down as to what's happening, because plenty happening, especially post the IPO. Now that those IPO blues are settling down, we'll try and understand as to what next in terms of the glide path with regard to the company. But the first piece I want to really know is cash flow. And is that a concern? Because FY25, we saw negative operating cash flows come through. We'll try and understand as to what led to that and whether that unwind is already at play in FY26 or not. And if so, by how much? Typically, they've done a decent EBITDA to cash flow conversion. So this was a bit of a surprise, but we'll try and get more perspective to that. Second piece is with regard to organic business growth. Now, one is they've acquired a company and they're going into B2C, and I'll explain what the business is. But the other piece is with regard to the current business. How much are they looking to grow on the current base? That's what we'll try to understand. Third piece is, I did mention that they've acquired a company to do B2C. That will add around 100 crore in terms of top line. But what will it mean in terms of top line beyond FY27? What's the growth trajectory there? Because B2C is obviously a margin accretive business. We'll try and understand the margin picture as well, but also what the top line does in terms of the beyond FY27 picture. Now, the fourth piece is with regard to Kansar. This is a brand which they've started in the budget basket. And what that does in terms of revenue mix, because this is all fresh revenue which will come in. They have existing distributors. They just need to push out product to them, and likely those distributors will manage to sell the product. And therefore, what does this do from a top line standpoint for FY27 and beyond? This is not just beyond FY27. Last piece is with regard to margins for each of the verticals. We'll try and understand that better so that we get a better glide path on the 250 crore top line today. Where does it go? And can these margins, which have been a little bit choppy to say the least, can they continue to inch upwards as B2C business kicks in fully? Let's talk now about the company. Let's talk about the business first off. It's the leading organized decorative walls panel maker in India, and it's one of the leading brands. It has a 16% market share. This is as of FY23 basis its RHP. It operates on an asset-light model. I'll explain that. It uses contract manufacturers, and it uses another 180 odd distributors across India. That's the distributor network that they have to try and push their product out. So that's how typically they operate. Now let me talk about the products first before I go to the business model. In terms of the products, decorative wall panels, decorative laminates, profiles, moldings, translucent panels, highlighters, interior films. They operate across the board in all of these products. Interior films are adhesive films with surface enhancement, and exterior claddings as well, and adhesives. So they operate in all of these areas in terms of product. Now let me talk about the geography of sales. 98% or 97% of the top line comes from India. Just 3% is export, which is Singapore, UAE and Australia. That's the broad brush breakup. In terms of the product-wise split, wall panels is around 66%, laminates is around 26%. So that constitutes around 92% of the top line. That gives you a very good picture that a predominant chunk of the revenue today comes from these two alone. Let's talk about the geography as well. They have 180 distributors in 25 states and 5 union territories. The tilt is 27% south, 18% north, and 18% west, and 10% east. Central is just about 3%. In terms of, and this is basis FY25 revenue, mind you viewers. In terms of their warehouse, they have a primary warehouse which is sitting in Bhiwandi in Maharashtra. In terms of the business model, let me explain that to you and take a minute to do that. First, they design the product themselves. They hand the designs over to the contract manufacturer. They have over 3,000 different SKUs, which is unique products, which they have manufacturing agreements with contract manufacturers for. Those contract manufacturers will manufacture the product, so there's no plant or machinery on their books. They design it themselves. All the plant and machinery sits in the hands of the contract manufacturer. They take the product from the contract manufacturer, push it out to distributors, who then onward sell it. So that's broadly the way in which they operate their business. Now, in terms of the acquisition, they are now planning B2C. So they will not do it through distributors. They do it themselves in terms of sales. And they've acquired a company for that. So we will get to that and what that means for Euro Pratik in particular. And also, they just hold a 51% stake in that company. So it's not a wholly owned subsidiary either. Now let's talk about the metrics and what the company has done over the last 3 years odd. In terms of the top line, it's grown its top line by around 10%. Mind you, for FY22, FY23 and FY24, I've taken the standalone numbers. For FY25, I've had to take the consol numbers because there have been subsidiaries which have come into the picture. But a 10% growth is what they've done in terms of revenue CAGR. 280 crore odd is where the top line currently stands at. Keep that number in mind. In terms of EBITDA, the growth has been quite linear in that sense. It's been a 20% growth where EBITDA is concerned. EBITDA margins have risen as a result. The taxation is what has led to some bit of choppiness with regard to profitability. And that's why you'll see the profit after tax CAGR is just 10% versus the 20% EBITDA CAGR. So it's a couple of line items which have tilted, the profit number. Also, other income was higher in FY25, and therefore that higher tax on that other income, which flew down to a profit, also needs to be factored in. Now let me talk about the margin trajectory. And this is where it looks better. You look at the way in which margins have moved from 27% to around 35.5 odd percent. But in Q1 and Q2, the margins have come off, 29 and 24%. We'll try and understand as to what's playing out there. Let's talk about the balance sheet now. In terms of the balance sheet, you look at the equity in H1 FY26, the number stacks up in terms of book value at 240 crore, which is the equity plus the profit and reserves, sits at around 240 crore. It's a 3,200 odd crore market cap, and therefore you will extrapolate the price to book value at around 15 times odd. You look at the borrowing number, absolutely invisible. You can see that there's very little to no borrowing visible on the balance sheet, and the cash is also decent. They've got around 18 to 30 crore odd of cash over the last few years, which sits on their balance sheet. So we've given this a thumbs up as well. Let's talk about the cash flow now. In terms of the cash flow, this is where the concern lies, FY25. We'll try and understand what's played out and how likely is that to repeat. This is where it's a concern, but outside of that, you'll see cash flow is quite healthy in FY24. FY23 also was a bit soft. So we've given this a neutral, trying to understand as to what's likely playing out. Let's talk about the return ratios. In terms of the return ratios, it's very, very strong. You'll see return ratios fluctuating between 35 and 60%. It comes off, obviously, as capital gets added to the balance sheet. But nonetheless, this is a very healthy set, and we'll therefore give this a clear thumbs up, which is why the price to book is so high as well. That's one of the reasons or correlations that one can make. Let's look at shareholding now. In terms of the shareholding, pre-IPO versus now, that's where the shift has been. 70% promoter owned even now, and 30% owned by the public. That's how it stacks up. And therefore, we see no concern here because promoter holding is very, very solid at 70%. We've given this a thumbs up as well. Let's talk now about the acquisition and what the management guidance seems to suggest. They don't give top-line guidance, mind you, in terms of growth, but we'll try and understand it better when we speak with them. Now, let's talk about the acquisition itself. They announced acquisition of 51% stake in Euro Veneer World, which is a leading South India retail brand. The acquisition cost is around 76.5 crore rupees. It's fully funded by internal accruals. The stake buy is going to happen for 66 crore rupees, and a 10 crore rupee fund infusion in the company is likely to happen. Euro Veneer specializes in veneers, laminates, plywood and architectural surfaces. It connects directly with 3,500 designers and 2,800 contractors. So this adds to all of what Euro Pratik is doing. And let's try and understand what this means in terms of a valuation as well. They've acquired a 51% stake at 76 crore odd. Now, 115 crore is what is expected to be added to the revenue of the company, and around 20 crore to profit after tax. So this trades at around 7 times 1 year forward to the acquisition cost at which Euro Pratik has bought it, which doesn't seem particularly expensive. But that, of course, we'll get better perspective on going forward. In terms of what it's expected to add in FY27, I did mention 100 to 115 crore of revenue and 20 crore to profitability, out of which Euro Pratik is entitled to only 51%. So around 10 crore odd, 7 to 10 crore will accrue straight to Euro Pratik. Euro Pratik itself aims to, on a standalone basis, aims to grow its distribution network by 10 to 12%. That's something important to understand. And it intends to grow faster than the overall market. That is what the guidance is in terms of what has come through. Now, let's talk a little bit also about valuations, because that is crucial, right? Euro Pratik trades at around 55 times odd, trailing 12 months price to earnings. And it has actually done its IPO at around 33 times. So you want to be cautious here because there has been a run-up. But what you also want to understand is what the next 12 months will bring, because typically we look at 1 year forward price to earnings. But because we haven't been able to extrapolate that, we've given you the current trailing 12 months price to earnings. So while this is a thumbs down, this could well change basis our conversation with the management. So keep that in mind, viewers. This is basis standalone data available with us. That's the broad brush summary of everything that we've discussed in terms of metrics. Let's go across. We have Pratik Gunwant Singh, who's the chairman and managing director at Euro Pratik Sales, joining us. Great having you, Pratik. Let me start off by understanding from you. What does the acquisition add in terms of top line beyond FY27 for you? And what does it add in terms of existing business? Because you've also acquired new designers and the like. What does it add in terms of existing SKUs? Give us that perspective.
Firstly, thank you for having me here on your show. The acquisition, it's a company which has a legacy of around 25 years. So one of the prominent retail stores based out of Bangalore. So it will the track record is around 90 to 100 crores top line. So with a 51% equity, the top line will be directly added to the company. And for next year, we are targeting around 115 crores as a top line for FY27.
But what about beyond FY27? Can you give us a sense there, Pratik? Because does it mean that this company can help you and you can leverage your current existing systems to just accelerate your own growth, which is standalone, but also accelerate the growth of this company, which is likely to clock a top line of 115 crore in FY27?
Yeah, so as you can see, it's as on today, it's around 30 to 35% of our revenue, which will directly get from this acquisition. Also, we are planning to have more franchisee and more showrooms of the same Euro Veneer World in the southern part of the country. So we are looking to grow that, which will indirectly or directly help the parent company, which is Euro Pratik. In terms of SKUs, they are already one of the leading in the wall panels. Along with wall panels, we have also added premium laminates, premium veneers, and decorative surfaces for the interior decoration. So it's like a forward integration for us, where as on today, our major business comes from B2B. This will help us acquire the B2C and understand the market in a better way with architects, designers, directly in touch with the Euro Veneer World company.
Okay. And does this therefore mean better margins for you on the 115 crore of top line that you get in FY27? You've not given me a growth guidance beyond that, so I'm unable to clock or quantify in my head how that will play out. But at least for FY27, does that mean better margins on the 115 crore?
Yeah. So what we bring to the table is the sourcing. So whatever products, what they are sourcing, we are able to source it at a better price, at a better quality, and better service. So obviously that will really help the margins to go up for the Euro Veneer World. Also, we'll eliminate all the middlemen, and it will be directly from the source to the Euro Veneer World, and which will enhance the profitability of Euro Veneer World.
Okay. Is there at all a guidance I can get beyond FY27? What's the aspiration to grow Euro Veneer World? By how much? Would 20% be a decent growth clip?
That would be our internal target. We should be able to do that. Yeah.
20% you said. 20% is the internal target.
Yeah.
Okay. Okay, fair point. And your existing business, you said you'll grow distributors by around 10% odd, right, every year.
Right.
Does
Right.
that mean your sales grows faster than that, slower than that? How does it work?
So, as you are aware, in this year, in the first quarter, we had a devastating fire. So the numbers which you had shown on the screen, the first quarter was really impacted with that. From second quarter onwards, the business is normal, and yeah, we want to grow maybe 15% organically every year, plus the inorganic opportunities which will come through.
Okay, so on a 280 crore base, you'll grow 15%, and on the 115 crore base, you'll grow 20%. And where does Kansar stack up in all this? Because that's a completely new product line, right? That will grow
Yeah.
from zero. So basically, the growth there will be completely fresh, which will get added to your inorganic growth. Organic growth, I beg your pardon.
Yeah, yeah. So it's a brand called Canfor, which we have launched recently. It's been a couple of months. The response has been very encouraging. Uh, we are in the price range of very close to the paints. So that product is doing quite well. Also, we are launching the second volume in the month of February for the same product with more than 200 designs. So there are a lot of things in pipeline. So on a conservative side, I have given you the number. Hopefully, we will be able to overachieve what we have committed, what we have informed you just now.
Okay. So today, if I were to just broad brush take your FY27 estimates, it'll be 30% B2C, 70% B2B. Within that 70% basket, how much does the new brand contribute versus existing brands?
So yeah, the new brand should be around maybe around 15-20%.
Okay, all right. And how do margins shape up for you? You said B2C, the margins are better, largely because of efficiencies getting built into processes of the existing company. But once those efficiencies are built in, which is, I would assume, by FY27 end, that would likely happen. Give us a sense. FY28, will margins for your B2C business be materially better than your B2B?
Uh, uh, I think our the core business, the margins will be better because as a company, we are an innovative company and we keep on launching new stuff all the time. So that gives us a cushion for a better margin here. As our over the years, we have innovated. We have launched around 1,000 designs every single year for the Indian market. So these margins will remain to be healthy, I believe, and whatever retail will be an added advantage for us.
Okay. And how should one therefore uh, look at how your overall margin stacks up? Does your overall margin uh, be hovering between 27 and 35%? Is that what an investor should anticipate?
Are you talking about the profit after tax or EBITDA?
EBITDA margin, sir. So
Yeah,
your
that
EBITDA
that should
margins,
be
yeah.
yeah that should be in line of what you just said.
Okay. And is there a reason why FY25 was a difficult year in terms of cash flow conversion?
So as we were going public, all our different companies we merged into Euro Pratik so that we could not have any conflict of interest. So that was the main reason of just 1 year cash flow negative. Other than that, if you see over the years, last 7 years, company has been cash flow positive, and we in this year again we are again cash flow positive. So it's a debt-free company. We are growing organically plus inorganically. So barring 1 year where we had to do a lot of acquisitions internally before going public, now everything is streamlined as before.
Okay. You've entered that 130 to 170 rupees per square foot bracket in terms of pricing. How large is the market size there? How does it open you up in terms of the market size? Because you've always operated in the slightly more premium segment, if I've understood it right. Does this open a whole new market for you? And given your distributor and your reach, does this therefore give you substantial leverage? I know you've guided only for 15%. We've spoken about it. You said it's conservative. But I'm trying to understand how large the market is and how quickly can you tap into it.
Yeah, so the market is really growing this is a new age industry where 15 to 18% is the growth of the market for wall panel. So at a lower price and it's a very it's a new market. Also, it is very unorganized and regional based. So the response has been phenomenal. It's been just a couple of months. I won't be having a number to give you, but then things are looking very encouraging that side.
Okay. Yeah, I understand. You're on silent period. You can't give me a number for Q3 or Q4. No, but this gives us a sense. 18-20% growth market, 15 to 18% growth market, which is faster than your current organic market. Plus, it's a completely new market for you, I understand. So therefore, that adds. The margins there are better at all, or would it be margin dilutive for you?
In similar lines, maybe a couple of percentage lower than the premium products, but not significantly lower. It's on the same lines of our premium products.
Pratik, why are margins so choppy for you? Give us a sense. Why 27 and 35, 36%?
So there are few products which are ancillary products where the margins are little lower. And also we are into this fast fashion. So if the product gets outdated, we need to discard it at a lower margin. So that is the reason. But if you see over the years, the profit margin has remained sustainable at a higher 20s or 30%. I guess what you are showing is it? I think it's the standalone, not the consolidated. If you show the consolidated, it's around
the standalone margin. It's the standalone margin, Pratik. That's correct.
Yeah. So we generally, it's we work on the consolidated basis. So it's been in fact the margins have gone high on, if you see the consolidated numbers, it has gone high over the period of last 4-5 years.
Yeah, Pratik, unfortunately, I've had to take the standalone margins for FY22 and 23 and 24 because I didn't have those numbers available. And I could take console only for FY25. Therefore, you're seeing the numbers you're seeing. But I understand where you're coming from. Now, in terms of, so therefore, 35% is the margin that you're comfortable working with.
Yes.
Okay, and the flow through to profit after tax would then typically be clean because you have very little depreciation because of no fixed assets and you have no debt.
So as I said, completely debt free, no asset light model. Our core business is designing and our strength is distribution on the brand basis. So there is no other cost added after the EBITDA. It's just hardly any depreciation and then the tax.
Pratik, what do you do with the cash coming through?
So as I said, we did the acquisition of the Euro Veneer World. We'll be utilizing the internal accrual for that. Also for future opportunities to grow the business, there are two verticals, two ways of going about it. One is organic and other is inorganic. We are aggressively looking for more opportunities to grow our company. We feel our base is now very low, and it's a good opportunity to have more inorganic opportunities at a good valuation to grow the company from here.
How lower, Pratik, are the margins in B2C versus B2B? Because you'll have to open retail stores and the like. So I understand that, but how lower are they?
So generally, the retail is on franchisee basis. So there is no added cost. The franchisee owner bears the cost of the showroom. We want to remain asset light. That is what we prefer. That is what we have been doing over my personal experiences last 2 decades. So it's going to be asset light. But in terms of margins, it will be, I think, around 20 to 25%.
Got it. And the ROCE number, are you confident of maintaining the kind of ROCEs that you do? You do 50% ROCE.
Yeah. So maybe a couple of percentages plus minus, but we hope to continue that. So one more thing I would like to add here is the Euro Veneer World, the ROCE is around more than 80%. Because it's a pure retail and the cash flow is very, very strong. So the ROCE of our acquisition is more than 80%.
Fabulous. Thank you so much, Pratik. It's been an absolute pleasure speaking and understanding this space as well as Euro Pratik Sales in particular. Thanks so much for joining us this afternoon. And viewers, completely timed out on this edition of All About Your Company. I hope you found this fruitful. From all of us here, thank you so much for watching. Stay with us here on ET Now. More action on the other side.